Okay, financial reporting. Let's move forward. Test your understanding three. The cost of investment. The statement of financial position of P and S as at 30th June 2028 is given below. Property, plant and equipment for both companies. Investment. What does that mean? Consideration paid to acquire S. Instead of this, we need to record goodwill in consolidated financial statements. Current assets that we add together, share capital, share premium, retained earnings. Non-current liabilities are given. Current liabilities are given. What would you need to do? Prepare consolidated statement of financial position of P Group as 30th June 2028. P acquired 60% of S on 1st July 2027 when the retained earning of S were 5,800. S means subsidiary retained earning at the time of acquisition were 5,800 while reporting rate 7,200. How much is the change? 1,400? Yes. 60% is parent company, 40% is of NCF. P paid 5,000 in cash. P also issued $2 shares for every 5 acquired in S and agreed to pay a further 2,000 in 3 years' time. The market value of P's share at 1st July was 1.8. P has only recorded the cash paid in respect of the investment in S. Current interest rate are 6%. The P group uses the fair value method to value the non-controlling interest. At the date of acquisition, the fair value of non-controlling interest was 5,750. Good luck, everybody. Can you please calculate goodwill figure for me? Goodwill is becoming negative. No, how it become negative? First, you need to calculate consideration paid. How much is the consideration paid? 6680. Now. Six and 679. Sure. 5,000 multiply by 60% multiply by 1 share for 5. He also issued 2 for 5. Multiply by 1.80. Its total share is R 5,000 in a. Out of that, you are requiring how much? 60%. Whatever you are requiring, for every 5 you are giving to. How much is that? 2160. So consideration paid will be 8839. 8839. So fair value of that asset required. That is, how much is the fair value of asset required? Or you need to add first non-controlling interest as well. How much is non-controlling interest is given at fair value 5750 less fair value of assets. That is 10,800. So we are having goodwill with the amount. $3,789. What else? That we can calculate easily. So property, plant and equipment will become 95 plus 15, that will be 24,500. Instead of investment, goodwill will be 3789. Current assets we will add together 12,500. Total assets figure we can calculate. Share capital will be 6,000. Share premium will be 4,000. Retained earning 12,500 plus 840. 12,500 plus 840. 13. 12,500 plus 840. 13. 13340. Non-controlling interest, we are having figure 5750 plus 560. 6310. Current liabilities, no. No, 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 no. What is about this contingent consideration? We need to record finance cost. Need to record non-current liability. So non-current liability, we will calculate how 1,000 plus 500 plus 1679 plus 6% of 1679. 6% of 1679. What is that? Yeah. How much?
101.
101. That will be added relating to unwounding. Now please calculate this non-current liabilities for me.
328.
32 for retained earnings. Adding these plus what's the accounting entry for unwounding? Finance cost debit. Non-current liability credit. That finance cost will be having effect with retained earning. Whether that will be deducted from retained earning or that should be added with retained earning. If it is income, that will be added with retained earning. If it is expense, that will be deducted from retained earning. So we need to deduct 101 from these figures. Now see what is that. 12,500 plus 840. 12,500 plus 840 minus 101. What is that?
13239.
13.
239.
How to calculate that? That unwounding discount 6% on this amount, contingent liability, finance cost debit, where retained earning is a credit balance equity. So debit will reduce it and should be added with this amount to record as non-current liability 1679 plus 101. Are you with me? Are you with me? What is figure for current liabilities? 5,800. Now, can you please find the total whether they agree with each other or not? What is figure for total assets?
40489.
40
489. So,
24,500 plus 3,789.
37.
3,789 plus 12,500. What's that?
Yeah, 43709.
40789. Now please calculate. Is the share capital 6,000? No. We issued some shares here, na? How many shares we issued? How many shares we issued? Can you calculate the share? 5,000 multiplied by 60% into 2 by 5. How many shares? 1,200 shares we issued. So 1,200 multiplied by 1 par value will add to share capital. So share capital will be what? Plus 1,200 means 7,200. And remaining will be charged to share premium. 1,200 multiplied by 0.8. What's that? 960. So share premium will be 4,960. Is that?
Yes.
Now, can you please calculate total equity and liabilities for me to see whether they equal to 40789?
Avoid. Yeah.
960. We issued 1,200 shares into 1.8. This means 1 is the normal price. 0.8 is what? Premium. So 1,200 into 0.8 is 960. And 1,200 into 1 is 1,200. And for this share issue, share capital is 1,200 into 1, that is 1,200, and share premium 1,200 into 0.8, that is 960. Is that? Can we move forward? Yes. I'm leaving this chapter here. We are moving towards theory chapter, pure theory of consolidation. Because we could face some MCQs from consolidation based on theory as well, because the previous chapter 17 is totally theory. So let's discuss this. What is group? If one company owns more than 50% of ordinary shares of another company, that will be called group. In case of group company, we need to prepare consolidated financial statements. Who need to prepare? Parent company. So this will usually give the first company control of the second company. In one company is having a control over their company. The first company, the parent has enough voting power. Enough mean more than 50%. Appoint all the directors of the second company means subsidiary. Control. And he can decide about everything of that company, even about directors. P is able to manage S as if were merely a department of P rather than a separate entity. Though it is operating separate entity, but they can manage everything. They can influence everything. In strict legal terms, P and S remain distinct, but in economic substance, they can be regarded as a single unit. In legal reality, obviously they aren't, but economic reality, that will be so. So we need to prepare group accounts. The key principle underlying group accounts is the need to reflect the economic substance of the relationship. First we need to find relationship. P is an individual legal entity. S is an individual legal entity. So P control S and therefore they form a single economic reality, the group. So that's why the result will be consolidated. The single economic entity concept, the purpose of consolidation account is to present financial information about a parent undertaking at its subsidiary undertaking as a single economic unit, means they will prepare their accounts separately. But parent company need to prepare consolidated financial statements as well. Show the economic resource controlled by the group, show the obligation of the group, and show the result of group achieve with its resources. Consolidated financial statements under the single entity. This is group financial statements. There are three IFRS accounting standards in case of consolidation. One is IFRS 3 business combination. And this standard providing how to calculate fair value of consideration paid. That we have studied so far in case of share, in case of contingent consideration. IFRS 10 about consolidated financial statements mean we need to record goodwill asset, we need to record non-controlling interest, we need to record parents' retained earning. Other things we need to just add up. IAS 20 investment in associate and joint venture. What is this? We will study later on. Probably in chapter 20, not before that. What is associate? What is subsidiary? Investment greater than 50%. What is associate? Investment greater than 20%, but less than 50%, mean between 20 and 50. If less than 20, nothing. If investment greater than 20, but less than 50, that will be called associate. If investment more than 50, that will be subsidiary. What is associate? We will have learn separate chapter on it. So each company in a group prepare its own accounting records and annual financial statements in the usual way. From the individual entities' financial statements, the parent prepare consolidated financial statements. Only parent will prepare consolidated financial statements. In addition to the above accounting standards dealing with the preparation of consolidation financial statements, the IASB now has issued IFRS 12, disclosure of interest in other entities. There is another accounting standard about disclosure, that is IFRS 12. Definition: what is parent? An entity that control one or more entity. What is subsidiary? An entity that is controlled by another entity, mean parent. Control of an investee. Investee means subsidiary, investor mean parent. An investor control an investee when the investor is exposed or has a right to variable return from its involvement with the investee. It has the ability to affect those returns through its power over the investee. Mean he will receive return and he can influence return through his power. So control is defined by IFRS 10 as the sole basis for consolidation. Mean if you are having control, you will prepare consolidated financial statements. If there is no control, you will not prepare consolidated financial statements. And comprise the following three elements. Power over the investee. When you are having power, when you are having more than 50% voting rights. Up to 50, you cannot impose anything. Your vote will be cancelled by other 50. Exposure or right to variable return from its involvement within the investee. Mean the return you are having a right to receive, and those returns are not fixed. Mean that is not interest, that is based on profit variable. If you have provided money against a fixed return, that is debt. That is not position. The ability to use its power over the investee to affect the amount of the investee return. Mean you will be involved in decision making. Through that, you can change the return. You can provide some resources if they are lacking so that they can generate more profit. Mean you are having the ability and power to influence the return. Obviously, return you will influence to increase rather than decrease. So being a parent company, exercise of majority of voting rights in investee, contractual arrangement between the investor and other parties holding less than 50% of voting rights will all other equity invested held by a numerically large disposed and unconnected group. Mean that is about others. Potential voting rights, don't need to read. Exception from preparation of group financial statement. Mean when you will not consolidate subsidiary, or when any holding company will not consolidate its financial statements. B is a company who acquired 80% of C. This means C is a subsidiary, B is a parent company. If B is acquired by any other company A with say 70%, A is parent, B is also parent, but as B is subsidiary of A as well, and C is a subsidiary, C is subsidiary of B as well as A. Because B is subsidiary of A, whatever is under B, that is of A as well. This means A is having one subsidiary B and one sub-subsidiary C. A will prepare consolidated financial statements must. And if A is preparing consolidated financial statements, B is allowed not to prepare consolidated financial statements. Mean it will prepare its individual financial statements, C will prepare individual financial statements, A will prepare individual plus consolidated. Meaning if any entity is a parent company, but also a subsidiary of any other parent, then that entity like B is excluded from consolidation. Now read this. A parent need not present consolidated financial statements. Mean B. If and only if a parent itself is a wholly owned subsidiary or partially owned subsidiary and its owner including those not otherwise entitled to vote, have been informed about and do not object the parent not preparing consolidated financial statements. In simple word, if it itself is a subsidiary of any other parent company. The parent's debt or equity instrument are not traded in public market. In that case, parent don't need to prepare consolidated financial statement. The parent did not file its financial statements with a Securities Commission or other regulatory organization for purpose of issuing any class of instruments in a public market. Meaning parent company is not listed on stock exchange. They don't need to prepare consolidated financial statements, though they hold subsidiary. The ultimate parent company, who is ultimate? A is ultimate parent company. Though B is parent, but ultimate parent is A. The ultimate parent company produces consolidated financial statements to comply with IFRS and are available for public use. Ultimate parent company mean A. Here they talk about B. IAS 27 separate financial statements. When exemption from separate of financial statements is permitted, IAS 27 separate financial statements require the following disclosures are made. If you being a parent company not preparing consolidated financial statements, then you need to provide reason in notes to the accounts. The fact that consolidated financial statements have not been prepared mean why you are not preparing. You need to provide the fact according to these reasons. A list of significant investment subsidiaries, associates, including percentage of holding, principal place of business, and country of incorporation. You need to provide detail about your subsidiaries. The basis on which those investments listed above have been accounted for its separate financial statements mean on what basis, either on fair value, either on proportionate basis, how you are preparing financial statements, you need to disclose. Reason for wanting to exclude a subsidiary. Mean if you are not consolidating any subsidiary due to these reasons, that will not be accepted. Mean these are not a genuine reason. Due to these reasons, you cannot exclude any subsidiary from consolidation. Like if parent company is having 3 subsidiaries, 2 subsidiaries are profit making, 1 is loss making, and they excluded the loss making subsidiary. This reason will not be acceptable. You have to consolidate. If you have acquired more than 60%, you have to prepare consolidation. So the directors of parent company may not wish to consolidate some subsidiaries due to poor performance of the subsidiary, poor financial position of the subsidiary, different activities of the subsidiary from rest of the group. In some time directors put these kind of reasons. Excluded subsidiaries. Subsidiary can be excluded from consolidation in case of 2 situations. If subsidiary is held for resale, mean you acquired any business for resale purpose, not to continue for long-term purpose, then you can exclude it from consolidation. That is acceptable. If subsidiary account balances are immaterial, mean very small, even if you exclude, that doesn't affect the decision of any user, then you can exclude them from consolidation. Subsidiary held for resale, IFRS 5. So you need to provide separate disclosure. Materiality, if subsidiary account balances are immaterial from financial statement point of view, mean very small amount, doesn't affect the decision of any user, you can exclude from consolidation. Non-conterminous year ends. Non-conterminous, what does that mean? Different year end, mean not same. We need to consolidate subsidiary results with parent company. And for that purpose, subsidiary and parent company year end should be same. But there could be some cases where subsidiary year end is different. Parent company year end is different. Parent company year end is say 31st December, while subsidiary year end is say 31st March. Parent company preparing its financial statements on 31st December. Subsidiary preparing financial statements on 31st March. How you can consolidate at 31st December because subsidiary results are not prepared yet. In that case, what you need to do? First, try to change the subsidiary year end to 31st December. For this period might be you will prepare 9 months account, not for the complete year. But in future, the issue will be resolved. Or try to change parent company year end to 31st March. Mean for this year, you need to prepare 15 months account. And for future, the issue will be resolved. But these both companies operate in different countries. And according to country law, they cannot change their year end. Then what will happen? How you will consolidate? In that case, you need to consolidate at parent company year end. By meeting a condition. What should be the condition? The gap period between parent company and subsidiary year end should not be more than 3 months. Should be less than 3 months gap in year ends. In that case, due to different year end, you can prepare consolidation at parent company year end, even subsidiary year end is different. Either subsidiary year end is before parent company or after parent company year end, but the gap period should be 1, 2, or maximum 3 months, not more than that. If suppose subsidiary year end is 30th April, the gap period is more than 3 months, you cannot prepare consolidation at parent company year end. You have to move towards subsidiary year. How financial statements will be consolidated? At 31st December, you need to prepare subsidiaries 9 months accounts for this year. For remaining 3 months, you need to prepare additional accounts and consolidate. And from next, you will be having 1 year. Remaining 3 months, you will exclude, add to next like this. But that will be problematic every year. Like 9 months, you will be having separate accounts. 3 months, you will be having separate account to consolidate. 9 months, you can calculate from R and prepare financial statements. But for the extra 3 months, obviously financial statement prepared after 9 months. So you need to prepare some interim accounts for the 3 months and need to consolidate. So in case of different year end of parent company and subsidiary, first you need to take some steps so that year end should be same. But if they are different, you can consolidate at parent company year end. If subsidiary year end, either finish before or after parent company, but the gap period should be between 3 months. How we will consolidate? A portion subsidiary 9 months or 10 months and prepare additional accounts for the remaining months. So some companies in the group may have different accounting dates, different year end. In practice, such companies will often prepare financial statements up to the group accounting date for consolidation purpose. Meaning they prepare financial statements on parent company year end. For the purpose of consolidation, IFRS 10 states that where the reporting date for a parent is different from that of subsidiary, the subsidiary should prepare additional financial information as of the same date as the financial statement of parent, unless it is impracticable to do so. Mean for extra month, you need to prepare extra accounts. If it is impracticable to do so, IFRS 10 allows use of subsidiary financial statement made up to date of not more than 3 earlier or later than parent reporting date. In subsidiary year and should not be more than 3 months gap. Either it could be before parent year end, either it could be after parent year end, but the gap between these two year end should not be more than 3 months. With the due adjustments for significant transaction or other events between the dates. Uniform accounting policies, what does that mean? Uniform, same. Parent company and subsidiary should have similar accounting policies. If they are different, you need to define same accounting policies for the same group. But if they are different due to some genuine legal reasons, like parent company is preparing financial statements as per IAS, IFRS, subsidiaries operating in a different country, and in that country they need to prepare financial statements as per US GAAP. In other type of accounting standards, generally acceptable accounting principles. This is the name of other type of accounting standards. So in that case, what you need to do? You need to adjust the subsidiary accounts according to group accounting policy. And you need to provide a disclosure in consolidated financial statements. Mean due to different accounting policies, what is the change in results that are different due to different accounting policies? Obviously, some figures will be different, other figure will be same accounting policies. So it is a matter of group uses accounting policies other than those adopted in the consolidated financial statements for like transaction and event in similar circumstances. Appropriate adjustments are made to the group members' financial statements in preparation of consolidated financial statements to ensure conformity with the group's accounting policies. Mean you need to prepare as per same accounting policies, but you should provide a disclosure. Look, everybody, we test your understanding one, requirement one. Option A, B, C, D. Which of the following definition is not included within the definition of control? Having power over the investing? Yes. Having exposure or right to variable return from its investment in the investee? Yes. Having the majority of shares in the investee? No. Having the ability to use its power over the investee to affect the amount of the investee's returns? Yes. So which one is not in the definition? See, there was no majority. What does it mean by majority? In law, majority means 75% or more. Number two, which of the following situation is unlikely to represent control over an investee? Owning 55%, mean more than 50% holding, and being able to elect 4 of the 7 directors. Yes, because you are having major voting, even you can elect all 7 directors through voting. Owning 51%. But the constitution requires that decision need the unanimous consent of shareholder. No, don't need unanimous consent of shareholder because you are having 51%, you can decide anything.
Constitution required.
No, no need for constitution required. If you acquire 51%, you acquired it through agreement. So this is unlikely. What do you see? Having currently exercisable option which would take the shareholding of the company to 55%, owning 40% of the shares, but having the majority of voting rights within the company. Which of the following situation is unlikely to represent control over an investee? B or D? Unlikely to represent control over an investee. In control, was there any information about holding? Owning 40% of the shares, but having the majority of voting rights within the company. Due to majority of voting rights or majority voting rights, you can influence, you're having control, even though your shareholding is 40%. In B, you need a unanimous consent of shareholder. This means if you need consent of other shareholder, you cannot influence. This means you are not having control. So B is not having. Number 3, which of the following is not a condition which must be met in the parent to be exempt from producing consolidated financial statement? The activities of the subsidiary are significantly different to the rest of the group, and to consolidate them with prejudice the overall group position. So this is not a proper condition. The ultimate parent company produces consolidated, through this you can be excluded from consolidation. The parent debt or equity instrument are not traded in public market. Yes. The parent itself is a wholly owned subsidiary or partly owned subsidiary of another entity who is preparing consolidated financial statements. So ultimately, this is not the proper reason of exclusion. Mean exclusion from consolidation. Number 4, which of the following statement regarding consolidated financial statement is correct? For consolidation, it may be acceptable to use financial statement of subsidiary if the year end differ from the parent by 2 months. Yes, gap period is less than 3 months. What is B? For consolidation, all companies within the group must have the same year end. No, they could be different. All companies within a group must have the same accounting policies in their individual financial statements. No, they could be different. Only 100% subsidiary need to be consolidated. No, more than 51% need to be consolidated. Is that? Then these are illogical. Finish. Move back to previous chapter. We are having good time. So let's move forward. Let's discuss some more concept. Fair value of net assets acquired. How to calculate? We need to calculate net assets at the time of acquisition, at the time of reporting, and we need to see post acquisition changes. We need to record assets of subsidiary at fair value. We need to record assets of subsidiary at fair value. And we calculate fair value of net assets using the share capital plus reserves. Reserves mean share premium, revaluation reserve, retained earning. And if there is a change in fair value and book value of asset, we need to adjust that change. How we can adjust that change? Fair value adjustment. We need to add here and here. If fair value of asset is more than the book value, so we need to make adjustment. We need to add the additional counts. Yeah. And due to that addition of a fair value, ultimately the asset depreciation will be more. That we need to deduct from. But at the reporting date, because depreciation will be recorded at the time of year end. So we calculate fair value of asset using share capital plus reserves. But if the assets fair value is more than their book value, so we need to make adjustment. Mean how much is the difference between book value and fair value? That we will add in acquisition date net assets as well as reporting date net assets. And due to addition of a fair value of assets, there will be more depreciation. So that depreciation we will deduct at year end. So IFRS 3 require that the subsidiary asset and liabilities are recorded at their fair value for the purpose of calculation of goodwill and production of consolidated accounts. Adjustment will therefore be required where the subsidiary's financial statements do not reflect the fair value of assets and liabilities. How to include fair value in consolidation working? Adjust to bring the net assets to fair value at acquisition date, taking into account any subsequent effect that will have on the year-end position. This will ensure that the fair value of net assets is carried through to the goodwill and non-controlling interest calculation. Because non-controlling interest, we will calculate from here. And for goodwill, we need this fair value of net assets acquired. Your understanding for this is a long question. We'll cover next lecture. Post acquisition revaluation. Post acquisition revaluation. Mean after acquiring the subsidiary, if there is a revaluation of assets. Due to revaluation, what will happen? Due to revaluation, what will happen? Asset value will become more. Mean we need to charge debit to asset. And at the date of acquisition revaluation and at the date of reporting date, the valuation difference That will be due to revaluation. So the same way we are charging a profit of subsidiary to parent company retained earning and non-controlling interest. In the similar manner, we need to distribute revaluation after date of acquisition to parent company and non-controlling interest. P has owned 80% of S for many years. This means 20% non-controlling interest. During the year, P and S both revalue their properties for the first time. In parent and subsidiary, both properties revalued. And both properties increased by 100,000. Mean revaluation surplus for parent company 100,000 and for subsidiary also 100,000. Altogether, how much? 200,000. Mean consolidated property, plant and equipment will be debited by 200. What is the revaluation surplus relating to subsidiary? 100,000. This 100,000 is for parent. So for subsidiary 100,000 revaluation surplus that has been increased after acquisition. Out of this, 80% will be charged to parent company and 20% will be charged to non-controlling interest. Where non-controlling interest we record under equity. If we need to add 20,000 to non-controlling interest, we will debit or credit non-controlling interest. Equity balance is credit. To add, we need to credit non-controlling interest with 20. Out of this 100, 80 is part of our parent company. Where it will go? In parent company retained earnings. $80. And 100 will go to parent company retained earning through its own revaluation. Property, plant and equipment for the consolidation in group. 100 for parent company, 100 for subsidiary because we need to add non-current assets. So property, plant and equipment will be debited by 200. 100 of parent and 100 of subsidiary. But the parent retained earning will take 100 complete of himself and 80 of subsidiary share. While subsidiary 20% is the share of what? Non-controlling interest. So we'll record accounting entry debit property, plant and equipment, credit parents retained earning or consolidated retained earning, credit non-controlling interest. So if there is a post-acquisition revaluation in the subsidiary's non-current asset, the full amount of gain should be added to non-current asset. The non-current asset will be debited with the full amount. The parent's share of gain is taken to the revaluation surplus or retained earning, with non-controlling interest gain being taken to non-controlling interest. Uniform accounting policies. Okay, let's move towards another concept, intergroup trading. Parent company, subsidiary company. Parent company sold some goods being inventory to subsidiary for say 150. They sold on credit basis. Mean parent company recorded receivable debit, sales credit, subsidiary recorded purchases debit and payables credit. mean parent company will record receivable, subsidiary will record payable. In consolidation, it will go see asset 150, liability 150. You need to eliminate these receivables and payables from the group. It's like you have taken goods from one pocket and put in another pocket. Receivable mean receivable from outside the company, not from your own. Payables mean payable to outside the company, not within your. So in case of intergroup transactions, what we need to do, we need to eliminate any receivables, payables relating to intergroup transactions. Can you understand this? What's next? Normally, they record this purchase sales on markup basis, not on cost basis. Obviously, they send 50 100 units to S. What is the price of 100 units? They will record on price. And in price, cost and profit, both part included. And this profit part included in under group transaction is unrealized profit. You haven't earned this profit. If you are putting the goods from one pocket to another pocket, have you earned the profit? No. Profit will be realized if you sold these goods outside the group. So in intergroup transaction, first, if there is any receivable, payable that we need to eliminate, and we need to eliminate this unrealized profit part. Where this unrealized profit part is included. Where this unrealized profit part is included. That is included in inventory. Because subsidiary purchased the inventory with the similar amount they recorded purchases where inventory. That is also recorded in parent company retained earning through sales profit. So from where we need to deduct it from inventory and from retained earning. In case of intergroup transactions, first we need to eliminate receivables, payables related to intergroup transactions. Mean we will deduct the similar amount from receivable, consolidated receivable, and similar amount from consolidated payable. Because the receivable of parent subsidiary both added together in consolidation. Payable of subsidiary parent both added together in consolidation. This means we need to deduct 150 from receivable, we need to deduct 150 from payables. And now we need to see in this 150, how much is the profit part. Suppose inventory cost was 100 and profit part was 50 and selling price they recorded 150 transaction. This means this 50 is unrealized profit that is recorded. In parent company, profit mean retained earning because profit where it go in retained earning and in inventory of subsidiary. If it's in inventory of subsidiary, it will be in inventory of consolidation because current assets will add together. How we can eliminate it from inventory? By credit the inventory with 50. How we can eliminate from retained earning? By adapting retained earning because retained earning is having credit nature. Adapting mean reducing. So if there are intergroup transactions between parent and subsidiary, first we need to eliminate receivable payables relating to that. Simply deducting from consolidated receivable and deducting from consolidated payable. When we are adding receivable of both, we'll deduct these amounts. And in case of intergroup transactions, the unrealized profit part we need to eliminate from consolidation, from inventory and parents retainer. Now I'm adding one thing more. They sold 150 inventory within the group. Out of this 150, half sold outside group and half remaining within the group. If nothing sold outside, the complete inventory is where? In your home. The complete inventory profit part mean 50 is unrealized. That you need to eliminate. If half sold outside the group, this means for half profit is realized. From where? Outside the group, general public. Relating to half inventory, there is unrealized profit. Then we need to pass this inventory entry with how much amount? Half 25 rather than 50. This means if any inventory involved in intergroup transactions, the unsold inventory at the year end. From unsold inventory at the year end, we need to eliminate unrealized profit part. Whatever is sold outside the group, that profit is realized. Whatever is left unsold inventory involved in intergroup transactions, mean we need to eliminate unrealized profit from unsold inventory at the year end. Can you understand this? So P and S, parent and subsidiary, may well trade with each other, leading to following potential problems areas. Current account between P and S mean current account mean current assets, current liabilities in terms of receivables, payables. Loans held by one company in the other liability. These things don't study yet. Current account. If P and S traded with each other, this will probably be done on credit. Note that these intra-group transactions are usually recorded within a single account in each entity known as current account. This will lead to a receivable for one entity and payable for the other entity. So these are amounts owing within the group rather than outside the group, and therefore they must not appear in consolidated statement of financial position. So that's why we need to eliminate from receivables and payables. They are therefore cancelled against each other on consolidation by deducting from the relevant lines on statement of financial position. There was some information about unrealized profit. What is unrealized profit? In case of intergroup transactions, if transaction perform on selling price, including profit part. So that profit part is called realized profit. So profits made by entity within a group on transaction with other group entities are recognized in the accounts on the individual entities concerned. But in terms of group as a whole, such profit are unrealized and must be eliminated from the consolidated financial statements. Unrealized profit may arise within the group on an inventory where entities trade with one another. or sometimes entities sold asset with each other. And they are selling asset based on market value. Mean there is a gain or loss on disposal. So provision for unrealized profit we need to create. There was some rule that I want to get. Make the adjustment relating to unrealized profit. If the seller is the parent, mean parent sold to subsidiary. Who recorded the profit? Parent. If the seller is parent, the profit element is included in parent retained earning. So we need to eliminate from parent retained earning. How? By debiting parent retained earning and crediting inventory. If the seller is the subsidiary, where is profit recorded? Subsidiary financial statement. But subsidiary is also having other investors. In that case, that profit part you need to distribute between non-controlling interest and parent company. The profit element is included in subsidiaries retained earning and related party to the group party to any non-controlling interest. So what adjustment you need to make? Debit subsidiary retained earning, credit group inventory. But there is part of non-controlling interest as well. A subsidiary sold to parent company. The other investor will not believe you sold to parent company. You sold, give us our profit part. So we need to give their profit part. For that purpose, we need to record accounting entry debit retained earning with whatever is our percentage, 80%. Debit non-controlling interest and credit inventory with 100%. If the seller is a parent company, how we can eliminate unrealized profit, debit group retained earning, credit inventory.
Mhm.
But if the seller is subsidiary, in that case, we need to record accounting entry debit subsidiary retained earning, debit non-controlling interest, and credit inventory. And that's it. Remaining we'll discuss in next lecture. I'm giving you 19 minutes. We'll take back any other.
What's the next?
When is the next class? Good question. Good question. When should be the next class?